Well, welcome everyone to today's webinar titled From Risk to Resilience, Mastering Core Treasury Challenges. This is Brian from Strategic Treasury, and we're pleased you could join us as we discuss pressing issues Treasury professionals face and how to respond. Our speakers for today are Dory Maloof, Director of Value Engineering North America at Kyriba, Steve Bullock, Vice President Financial Services at Kyriba, and Craig Jeffrey, Founder and Managing Partner of Strategic Treasurer. Welcome, Dory, Steve, and Craig, and I'll now turn the presentation over to you.
Thank you so much, Brian, and welcome, Dory and Steve. It's good to be talking with you again on this particular webinar and these topics.
Thanks, Craig.
Yeah, great to be here.
It's nice that we can be connected from 3 different locations and still cover a lot. Thanks everybody too for joining. We know there's a lot of things to do during your day. We're glad you're spending some time with us. So thank you so much for that. Let's get into what we're going to be covering. This is going to be less of a slide flip and more of a discussion on some of these topics. We will cover geopolitical risk. What are some of the steps necessary to cover and manage geopolitical risk? That'll be a little bit about the broader context, some economic and geopolitical activities. Then we'll look at counterparty risk management. This is a re-emerged issue or increased focus for organizations since the beginning of last year. It's quieted down a little bit in the overall industry as things appear to have quieted down, but certainly some things that we should be discussing about how do we handle the different potentials, managing and monitoring that. Then we'll look at one of the most important topics in Treasury's domain is cash flow forecasting. It's been one of the key areas and topics for usually about a decade if you look at the different surveys and results, what people are spending the time and what they're doing on it. Then we'll look at staffing and scalability. How do we adapt to the change that's upon us? Change in tech, change in mindsets and age cohorts. So we'll have a little bit of fun with that. And then we'll look at securing payments. This is one of the most significant areas of risk and attention and concerns that people have who run payments, whether it's Treasury, AP, or other payment professionals. So we'll look at some of these top issues. And then, of course, we're going to do a little bit on the key takeaway side, summarize some of the findings here from our discussion. So with that, let's begin. I'm going to take the slides on and off. So I'll just pause the share. I guess maybe I'll even stop the share, and that should put us in a little bit more full screen. Yeah. So what are we looking at? What's going on? There's a number of current events that are going on. We have the multiple wars, Russia continuing to attack Ukraine and the battles there, particularly large concern for those in Europe. We look at what's going on with Israel, Hamas, and those activities. Those are, impacting both the Middle East, and then they're being watched carefully. I think it was this past weekend, or maybe a little bit before, where the Chinese Navy had exercises and surrounded Taiwan, running things. There's certainly no shortage of excitement, which is, kind of what we see. But also, when we look at economics, and I'll let Steve and Dory jump in here in a moment too. What do we see? Inflation rates, if we go back to June of 2021, it was 5.4%. June of 2022, it was 9.1%, which represents the peak. Our last rate from last month in April 2024 in the US was 3.4%. So it's coming down, not quite to the target and hope for range of 3.4%. I'm sorry, 2%. That the Fed's looking for. On the food price side, as we look at cost of food prices in 2021, food rose 11%. Half a year later, June 2022, it was still 10.4% up from the prior year. The last 12 months, as of April, it was only up from 2.2% from those prior numbers. So certainly movement on the price side. Unemployment about 3 years ago in June was 5.9% in the US. It's now 3.7% from the most recent numbers. So the unemployment rate is coming down. More people are coming into the workforce. The cost of energy and gasoline is higher than than July, higher than, well, most recent years, about 361 a gallon currently, a little more elevated than those prior times. So prices have changed. There's a number of geopolitical risks. I think one of the key things is to identify what are these risks, which ones impact your organization, how do you monitor those, what are things you can do to mitigate what goes on. So issues, things like supply chain may seem very far away from the treasurer, but issues of inflation, interest rates, that all factors into the cost of borrowing for Treasury. Supply chain disruption has ripple effects on not only costs, but how the organization runs and operate, pointing to a need for more consistency and margin. But those are having visibility to what those are, knowing what your capacity for those different risks that you may face and the exposures. Those are some of the core areas that we see. Dory and Steve, I don't know if either of you wanted to just jump in, and maybe Dory, you could start with any comments on the geopolitical risk front.
Yeah, in addition to everything you just mentioned, Craig, there's over 50 countries that are hosting elections this year. And that's, I believe the last statistic that I saw is that 10 most populous countries are holding elections, and we're one of them. In addition to that, so in addition to wars, there's a lot of changes that are happening politically, globally. So on the economic side, all the data you reference is simply indicating that the Fed's indication on when they are going to reduce rates or anything like that is kind of steady as she goes. We started the year with the potential for six rate cuts. That was the forecast at the beginning of the year. Now they're just hoping for one, if that even happens. So you're talking about an environment where you have high interest rates impacting the costs for organizations when it comes to capital. You have supply chain disruptions that you talked about earlier, not as bad as it was at the beginning of COVID, but there's the potential for bad if these wars get worse, if Iran blocks the Suez Canal, and if other things impact shipping routes, then those costs continue to go up for organizations. And what we're seeing on our side, when I work with clients, and actually I'm working with a specific one right now, where we're actually able to map out for them different scenarios when a shipping disruption happens, to indicate what the impact of that disruption will be on their specific cash flow that they're looking for from the receivable side. Because you can always control the payable side. It's the receivables that's in question now. So there's different ways of managing it, but the key is making sure you leverage technology to do that, because Excel can only give you as real as your capabilities to extract the data and your capabilities to do a lot of data integrity checks and in your ability to make sure that the data is refined and making sure that it's reliable and timely. Usually doesn't happen in Excel. You need to leverage technology to be able to get as real time as possible, because that's what's going to enable you to weather any environment, regardless of whether it's political, war, or economic, depending on your organization and what impacts it. What are your thoughts on that, Steve?
Well, first of all, there's been quite a few questions about the slides. There are no slides right now. All you can see are three handsome guys. So don't expect any more than that for the time being. But getting to the point in question here about the risks, I mean, as Craig said at the beginning, and Dory also touched on, there's wars going on. There's lots of elections happening. For some reason in the UK, they've decided to do the election on July the 4th. I don't think they celebrate anything in the July the 4th over there. And there's also obviously the aspect of interest rates and currency rates. So I was fortunate enough this past weekend to actually be in Taiwan. Whereas Craig mentioned there were some war games going on, and I actually asked a few Taiwanese people their perspective on the posturing. Their perspective is, here we go again. This has been happening for years. It's much more in the limelight of the news right now because of things that are happening elsewhere in the world, in Ukraine and in the Middle East. But this is something that just happens regularly. We don't think it's going to happen. I mean, that's obviously their opinion, but there's a lot more intense focus on the different situations that are occurring in these unfortunate situations, where obviously that is going to have an impact and has had an impact. And as Dory mentioned, wasn't that long ago that we were talking about COVID and the major impact that was having on life. Obviously, COVID's still going on, but we've learned to live with it. The situation in Ukraine has been going on for a long period of time, to the point where the markets have settled. We see ups and downs in the markets all the time, depending on what's going on. So I think from the sort of war perspective, that's one aspect. The elections, of course, depending on which side of the fence you sit on or your viewpoint, there's good and bad things about going either way. But I think, as Dory said, with 50 elections happening, 10 of which are in sort of major economic powers, that there's going to be some impact on that. But again, it's the impact, I think, based on what we've been seeing in the overall markets recently, is there's a blip, but things seem to recover. And then that brings us really down to interest rates. As Dory said, beginning of the year, there were high expectations for cuts. For a whole variety of reasons, that's been held off. They're still talking about cuts. Even this week, there's news expected. Got an update of when the next cut is going to occur. Is it going to be June? Is it going to be July? And again, if it doesn't happen, I think people are getting used to these, frankly, not so high rates if we consider the big picture. When I first bought a house, 12 months after I bought it, we were paying 15% for our mortgage. There were some interesting things happening back in that time, mostly political and mostly based on situations with certain countries. But the rates we're experiencing right now are not too different from the average that people have seen if they go back many, many years. It's just we've had a very low rate environment for an extended period of time. People have got used to it. Certain people were paying next to nothing for their mortgages, and I think we need to consider that whole big picture and history to really appreciate where things sit today.
The other thing I'll add to your point, Stephen, is that the interest rate environment, and the reason the Fed has opted not to move, has not been given the opportunity to move, is because the economy continues to outperform their expectations and inflation continues to be stickier. It's not high like it used to be a couple of years ago, but it's sticky. It's not moving down as quickly as possible. The consumer is still spending, although it's gotten a little bit lighter, but they're still spending. Consumer confidence is still fairly steady. It's a little bit lower, but fairly steady. And tomorrow we have the PPI coming out, and that should be a huge indicator of where the Fed's head is going to be. And I'm sure the market will have a reaction to that depending on where that comes in. And then we have the employment report the following week to see what's going on with the jobs market, which continues to be as low as it's ever been in history. So it's difficult for the Fed to take action when nothing is really breaking yet. They usually take action when something breaks, and there's no breaks yet.
Yeah, just picking up on a comment here from Erin Scardina. Hopefully I said your name correctly there. Rates may not be historically high, but prices are. Of course, you're correct. But when I first moved to America 18 years ago, it was $1.25 a gallon of gas, I believe. And it crept up and it crept up, and as Craig referenced, it's an average of 361. I think that, I don't know if that's in Atlanta or it's a bit more up here in Connecticut. But
national.
Prices go up, and very rarely do they go back down and retreat to the level they were at. People again, get used to the situation of the fact that they're paying more for a dozen eggs, more for a loaf of bread, more for a gallon of gas. And I think, unfortunately, to Erin's point, the high prices are probably going to stay. You may see some gradual reduction, but I don't think it's going to be as significant as the increase.
Yeah, some good points. Yeah, so some of the inflation rate has gone down, price level experienced a pretty good bump, and so we're seeing price increases on top of that. Generally, obviously, like you said, some go up and down. So some really good points. Excellent. So yeah, we're showing a slide again, and we're shifting to counterparty risk management. You know, back in 2008, 2009, there was a huge focus on counterparty risk management as there were a number of significant issues in the Great Recession. Earlier last year, when some banks got into trouble and it continued on, there was a refocus on some of the concerns about counterparty risk, what's going on with certain banks, what's risky, how do we look at this, and how do we handle and avoid some of the concentration risks that we see. Steve, I want to bring this and flip this back over to you after I talk about a couple of things. So on the screen, you can see how people, you know, what instruments they're using on the investment side to look at their total counterparty risk exposures in aggregate. You know, bank deposits, you know, quite large. Credit facilities, almost 40% look at it, and you can see those drop down. On the counterparty exposure side, what are people monitoring? The majority are monitoring bank balances, and you can see that slide all the way down to vendors. Only 20% are looking at those. They tend to look at those vendors that are the largest exposures, but you know, financial instrument counterparties like derivatives, fully a quarter look at those. Not everybody has derivatives or hedges, so there's certainly quite a bit of activity that isn't being done on the counterparty risk side. Steve, I'd love you to weigh in on what do we need to do from, let's say, maybe a visibility, calibration, diversification side, you know, operationally to manage our counterparty risk. And I'm going to drop the slides off now too, so nobody gets scared that we went back to just two handsome men and me.
So you're not showing slides right now, are you, Craig?
I am not.
We're going to go down to one handsome person. It's going to be Steve by the end of this.
So before I touch on the point about visibility and so on, there's a couple of things I think to acknowledge here from the point of view of the most recent counterparty risk concerns around SVB and First Republic. I think in the period from 2009 to 2021, there were over 500 banks within North America that failed. But the total amount of money that was impacted in those failures was less than the SVB and First Republic combined. So I think that there is definitely, and a lot of those 500 or so were absorbed by other institutions. So it sort of didn't even, again, cause a blip because it was just part of business, if you like. And I've spoken a couple of times this year around the impact of SVB and First Republic and how in certainly certain industries that were utilizing those banks in the main, they've really had to reconsider their perspective of how do they manage their cash, which counterparties are they using, how much money sits within those counterparties, are they getting less return but more comfort? Are they having visibility to what is actually contained within those banks and really the overall rating of those banks, with ensuring that for their shareholders, that they're not putting money into places where there is any cause for concern. And certainly, I think from the point of view of diversification, you know, there's been an enhanced use of money market funds. There's been an enhanced use of shorter-term deposits when people were sometimes locking money up for longer periods, for example, within longer-term CDs. And I think overall, I heard from a couple of customers a couple of months ago that their board's perspective now is they should have no more than $249,999.99 at each bank.
What if it's 98 cents? Is that okay?
No more than. So, some people have taken it to an extreme, but I was on a panel back in April with about 100 people in the room for the presentation, and around 15% of those firms hadn't moved their money out of SVB, even during the situation, and they still had their money with SVB. But of course, that there's a different situation at SVB. But it was amazing how certain people felt that to do nothing at that time was the best approach.
So, a couple thoughts on this. We've had a number of situations lately. Companies and individuals haven't lost money for their balances that are kept to those accounts. And so this can lull people into a sense of false security. It's, hey, FDIC made us whole, the other banks made us whole, we're all good. At the same time, we can also say, these banks are too big to fail. Nobody will let them go down because people say the word contagion, and they will fix all these problems for us. Therefore, we don't need to monitor counterparty risk as much. That's stated, and sometimes it's just implied by the actions. That seems concerning to me. Any thoughts from either of you on that?
Yeah, I definitely got thoughts on that because I think you're right. There is we forget things very quickly in this world, and I'm not going to even suggest why that is, but we move on very quickly. So the fact that you see people returning to SVB because they now fall under a different parent, the fact that so many people have taken their money out of these institutions that failed and put them, for example, into JP Morgan. JP Morgan were overwhelmed with the amount of work that they had at one point in time. So that's also a risk in itself if you're not able then to ensure that your money's in the right account at the right time. So I think we do sometimes, get lazy in how we think, but I think there always needs to be a minimum approach, which is to ensure that the counterparties that you're with are rated well enough above a certain level, that you are diversifying how your money is invested and who it's invested with and what period of time it's invested over. And going back to a point that Dory made, to ensure that you're obviously investing your cash on a timely basis, you also need to understand through technology, when do you need the cash that you're investing? How is your business calling that cash? Is it going to be required for an acquisition? Is it part and parcel of ongoing dividends that you're going to be paying? There needs to be a deeper understanding, I think, of the forecasting cash needs so that you can then deal with your money appropriately.
I think I agree with everything that you're saying, Steve. I'll add one thing that surprised me on that chart. The piece on the 20% being concerned on the vendor side, because the FDIC, the government, so on and so forth, have set the precedent that they're going to fix it if something happens with the bank. So that's what's created the sense of false security, or maybe it's not false. Maybe they'll spend any amount of money to make sure nothing happens from a contagion perspective. But what's interesting to me is on the vendor side, that's 20%. We have a lot of debt that was taken on by corporations during COVID. A lot of it was 5-year, 7-year debt. That's coming due next year. And a lot of those organizations that took out that debt happen to be the small caps or mid caps. So if you have a vendor that at that time during COVID was on shaky grounds and had to take on a lot of debt to sustain their viability during that shutdown period, and now they have all of that coming due when they have to refinance it at potentially higher rates, because it doesn't look like we're getting any low rates anytime soon. That could be an impact. So it's a small number in terms of what people are concerned about, but I think it has a lot of business continuity risk tied to it if you don't pay attention to it. So it's a very important piece because their viability, usually your vendor base, your supplier base, their viability is important to your business. So I would steer clear of paying attention to that.
Yeah, 20% monitor that, and so maybe they're only monitoring the largest ones, others are not. So certainly some good cautionary points there. Let's continue our discussion, but shift to cash flow forecasting. What's working? What are people doing? What's working? Here on the screen, you can see results from one of the surveys about cash flow forecasting. People capturing significant items on a one-off basis, 60% do that, 58%. Some of the methods that you learned if you're sitting for your CTP, the receipts and disbursement method, and then of course rolling average, and some that work really well when you're using Excel fit into there across the board. So people are using multiple different methods to do their cash flow forecasting. So Dory, for you, I'd love it if you could talk a little bit on what methods you see work well for forecasting, and if there's any guidance in terms of the types of cash flows that work well with those particular methods, that would be good. And then I guess as you're commenting on that, AI is a big topic. It's being used by an increasing number of treasury professionals, and a huge number plan to use artificial intelligence to help with forecasting, which is the area that most companies, treasury groups, spend the most amount of time in. They would spend more time in, and there's pressure to do better. So go ahead.
There's also pressure from the last question for you to do a poll, Craig.
Is there? How much pressure is there?
Well, 2 people so far have commented, so I think you maybe
well, let's
after
do it.
Okay.
Let's put a poll up. Let me share the screen so you can see the poll slide. I want to keep in good relationships.
You've got to keep the audience happy.
I'm sorry? I want to keep everyone happy.
You've got to keep everyone happy.
I want to keep 80% of people happy. How about that? So the poll is showing up. You can see it on your screen. This is concerns. So go ahead and answer. Our organization is moderately to heavily concerned about the below. Select all that apply. So you can select all of them, but if you select none of the above, you shouldn't have any of the ones above selected. The poll on this platform doesn't really force that, but just use your logical head to make sure you follow the rules there, and then hit submit, and we'll have a few comments on that shortly. So I'm looking forward to those responses. So yeah, that's our first sequence of poll questions. What are the concerns that you have?
And I think for the audience, it's good to know that if you would like a poll, you just need to ask.
That's how it works. As long as we have them, we can slide over to them. Yeah. Good stuff. All right. Let's just see in the chat box. Let me see if I can pull that up. I've got a different computer set up, and it is surprising how things look different when you have different computer screens and how long it takes you to get ready. If you want to type the word Kyriba into the chat box, you can type poll too, but if you know how to spell Kyriba, you can type that in. And once we get 150 Kyribas or poll, we will send all the poll responses out. We've always had a good group. You respond quickly. I don't want to harangue on it too much, but that's...
I've only seen one incorrect spelling of Kyriba so far, so that's pretty good.
Yeah. And Kyriba, yeah, awesome. So I'll just talk through these briefly, and then you'll move on to cash flow forecasting. But top concern, I think you can see it, 81% by far, number one. Slow growth and moving to recession, a little bit less than half, 45%. Still some concerns there. On the counterparty exposures, 34%. I'm hoping that our conversation moved that up a bit, but we didn't take it 2 different times. So that's where it sits. FX volatility, 32%. We didn't really even talk about that on the repercussions of geopolitical risk and trade, but that's a real issue. It's not one we're going to talk about on this webinar, but certainly one we could do a whole webinar on that issue alone, how to manage that, how to look at it. And supply chain issues takes the lowest level at just over a quarter of the audience. saying that. Any quick comments from either of you two?
I think it's a great segue to talk about the forecasting, right? Interest rates and growth and FX volatility. That has everything to do with forecasting and making sure that it's reliable, right?
Before you segue, I would just say as well, I think one of the reasons why interest rates inflation appears at the top of that is also related to people's personal perspectives, not just business perspectives. Because most of us don't worry about FX exposures or supply chain in our day-to-day lives, but we're clearly all thinking about the impact of inflation and interest rates. So I think that's another reason why it rises to the top and stands out.
Except toilet paper for about a month there.
Well, unless you've still got 400 rolls like I do in the basement from Costco.
All right. Well, Dory, why don't you talk us through cash flow forecasting then?
Yeah, I think a lot of it, you asked, what do we see working? I think garbage in, garbage out, right? Data integrity is key to a good forecast. That's the first piece, is data integrity. And how you get data integrity, AI has certainly helped that a great deal, right? AI has taken that by leaps and bounds farther than it's ever been in the past, and then being able to cleanse data and making sure that there aren't duplicates or errors and so on and so forth, and even project data based on history. So AI has helped a great deal there. The other piece is on the liquidity planning side, because when it's funny, because when we talk cash flow forecasting and you talk to us treasury nerds, I put myself in that category. We always talk about the cash forecast, right? The source and use and the 90-day rolling and looking at the variances in the 90-day rolling. We're seeing a little bit of a transition to full-blown liquidity forecasting, not just cash forecasting, and not liquidity forecasting in the long term, because people always think liquidity forecasting, that means like capital modeling. We're looking at quarters out or years out. We're seeing liquidity forecasting becoming relevant in the short term, especially with everything we just talked about on the geopolitical side and interest rate side. And what we mean by liquidity forecasting is all encompassing, not just source and use of cash forecasting. We're incorporating working capital. We're incorporating things tied to FX volatility into the forecast. We're incorporating any outside influences to the forecast, any economic indicators to the forecast, as well as what you have on the balance sheet from a debt perspective. So getting that holistic big picture view of your actual liquidity, not just source and use and rolling that over day by day or 90-day rolling. That's what we're seeing the transition to. And being able to look at it from a big picture perspective. So you're presenting to your CFO, not just here's what I'm looking at from a cash target, but here's what our liquidity actually looks like, taking into consideration credit facility capacity, any capacity on factoring programs or supply chain financing, reverse factoring programs. So all that stuff incorporated into a bigger picture than just a cash forecast. That's the key differentiator today.
Dory, let me ask you a question, if I may.
Absolutely.
If I'm allowed to on this panel, but I'm going to anyway. How do you ensure what you said at the beginning then, the data integrity? Now you're talking about all these different data points that come to give you that liquidity perspective, when sometimes people just think, oh, well, I just need a few numbers from different departments in the group. How do you ensure that what you're getting is accurate?
It's APIs, because you're only as good as the data is real, not just as good as the data is accurate, or the data integrity is there. When you leverage APIs and you're connecting to different internal systems that supply the data for your forecast, you're getting that data in real time. You're able to see that data as it changes on the ground. Right? You're able to make sure that your forecast is as real time as it can be, leveraging the APIs and the pulls that you integrate into your technology platform from different internal sources of your data. So that's if you're leveraging systems to do that. Some companies actually have direct input where they build multiple workbooks and provide access to people to have direct input into those workbooks. But ultimately, in the end, they're getting that data from somewhere as well. So it's not just out of thin air, let me just predict what's going to happen. That data is coming from somewhere, whether it's coming from history, from internal systems, or any projections you have on your organization's growth organically or through acquisitions. All of that can be married with APIs to make sure that it's as real as possible. And then leveraging APIs from the bank side to get the data, the actual data in more reliably to look at the comparisons and the variances and the trending as to whether you're running behind or ahead of your forecast targets. So you make reliable and timely decisions.
But you just mentioned a word which I think is key: reliable.
Yeah.
So many times we hear from people that we speak to in the world of Treasury that, well, sometimes I think this department's just given me a number to keep me quiet, or they're just updating this spreadsheet and just plugging some numbers in just to keep the forecast rolling, just to get it out of the way for this week. And I think although there's a lot of focus in firms to ensure that what they're getting is accurate, that reliance is something that they can only really enforce if they're in a position to compare the forecasts they're getting week over week and week over month, but ultimately then to compare what they've been told with versus what actually happens. And that's when you know whether or not what you're getting is reliable. And the tools that technology bring to the table for that ensure then that you can highlight those folk that are missing the actual by a fair amount and ensure that you understand why that is and address it for the good of the organization and the cash flow.
Yeah, there's nothing wrong with public shaming, right? I used to always put that data on the dashboard and show each division, each region, and where I got the information from. And I'm only as good as the information I'm told, right? My forecast is only as good as the information I'm told. So if you bring that to their attention, and you will be able to see, if you do what Steve mentioned, you will be able to see that there are certain regions or certain areas that the forecast is just completely unreliable, and when you compare it to others, and in overall scheme of things, it impacts your overall forecast. So that is another way of getting it corrected. So public shaming is not a bad thing.
Well, moving from public shaming to other types of data, I want to pull on the string a little bit because you said APIs will help, and I think they certainly will, because now you remove the latency issue of I get my data too slowly, and so I'm relying on older data. An API will allow you to refresh it, and so to the extent that it's accurate and it's more accurate over time, you're going to improve on that to the extent that you can get it more quickly. And if you run models on it, it can improve it over time. So I guess, faster data certainly makes things better, particularly, in the near term, let's say on receivables or payables, but you have to do other things with that data as well in many instances. So I'd like you to weigh in on the use of AI in helping with forecasting, right? There's challenges in every way: access to data, methods, modeling. AI is a huge topic in forecasting now. Any thoughts on that?
Yeah, data cleansing, right? You said the opportunity is there for the data to come in using API, but the system is only going to be able to take the data. Somehow there has to be some sort of machine learning or AI embedded in the platform that you're using to look at that data, cleanse it for you, and be able to tell you what pieces of that data have integrity versus what's garbage, and eliminate that garbage. So that's where AI fits in addition to machine learning, to look at history and be able to project into the future, look at the data, cleanse it out. I'll give you an example from the practicing side. When I used to be in Treasury at Forcia Automotive, we had a significant amount of issues from the data that we were getting from SAP. Significant amount of duplicates all the time, and different codes that come out of SAP from the receivable side on all these invoices that we were trying to project. How much are we getting paid from this OEM, and when is that payment coming in? We were able to isolate that data, leveraging the platform that we had to cleanse it out, remove using a process called batch modification. the data that was garbage, completely wipe it out, and leave the data that was clean. And that's how we were able to get the forecast significantly more reliable and be able to track it in more real time and see how we're trending.
I think the other thing is normalization of data. As Dory mentioned, from the point of view of liquidity positioning, if you're getting all these different data points in, you need to ensure that the data is consistent, so that then you're able to then look at it, compare it, and make decisions on it, because it is all then is consistent from the point of view of the view you have. But if you've got a file in some, in some language over here and a file in a different language over there, as Dory said, with different reference fields, those need to be aligned. Otherwise, you're just looking at gobbledygook.
Yep.
Excellent. We're going to, just like when you're listening to a podcast, sometimes you click the speed up to 1.1 times or 1.2. We're going to click the speed up just a little bit to continue to make our way through. So on the screen, you should be seeing, if it's sharing, hopefully it's sharing, you can see age cohorts. And so staffing and scalability is your next topic. Dory, you'll be lead off here. On the screen, you can see Gen Z, or the Zoomers. They're entering the workforce. They're doing work, all the way down to boomers who the majority have left the workforce. They continue to leave the workforce. Some of those are impacting the employment numbers and unemployment numbers as well. Now, there is a significant difference in terms of how people think individually, and then there's some generalizations by age cohorts. Tech is making a change too, Dory. I know you know this. I know you see this. One of the things that I find interesting, I tell this story, is that people that are doing manual tasks, they come into Treasury and they're in Gen Z, they're like, I'm not doing that manual task. And they'll just go down the road and everybody's like, they're lazy. They're not going to do it. And they're like, I'm not doing something that should be entered in the system. That prohibits me from gaining other and better skills. But what needs to change from the mindset or the action standpoint from any of these age cohorts, or how should we be looking at that, Dory?
I don't think the cohorts needs to change. I think organizations need to change and understand that these people typically come in. I felt the same way coming out of school. I just wasn't as vocal about it, right? Because I was in that Gen, I think X is my generation. But regardless, the highly educated, some of them are coming straight from master's degrees. Some of them have certifications. And they're absolutely right. They don't want to come in, download a bank file, and do data entry into an Excel spreadsheet to get a cash position for the day. They don't want to extract multiple files from multiple ERPs and build a forecast. They want the system to do it for them, and they want to use their brain to analyze it and make a decision on it, and not have to worry about the data integrity, or did they make an error, or what's going on here in terms of the data. So that is something that is on the organization side, right? Investing in technologies will only going to enable you to attract top level talent and retain that talent, because they're growing and they're involved in the organization in other areas other than just what they're doing day in and day out. Technology affords you the opportunity to do that. On the scalability side, we have a statistic that we use from a benchmarking perspective at Kyriba when we do value engineering exercises with organizations, that for every billion in growth, organizations that have the right technology are able to only add about a half FTE. So if you have technology in place, $1 billion company or billion in growth year over year, you're not necessarily adding that much overhead. Organizations that don't have the right technology in place for their team, for every billion, it's about 1.7. So call it 2 FTEs. So no technology, $1 billion company, 2 FTEs to manage day in and day out in Treasury. Organizations with technology, about a half FTE. Maybe that person is doing a combination of FP&A work, strategic work for the company, as well as kind of on the side managing cash flow, capital markets, so on and so forth for the company, or risk even. So that's the benefit from a scalability perspective. But I don't blame those Gen Zs for saying, hey, man, I did all this work in college. I don't want to come in and do all this data entry. That seems like beneath me. I don't blame them. They're not wrong.
No, it's
not wrong at all.
It's
Well,
certainly appropriate. Yeah.
I'll tell you something that they're all used to.
Yeah.
They've had technology since, or sometimes in certain cases, which I've seen on the street, before they can even walk in their hands. So they're used to having things that are up to date, automatic. They used to be able, they used to be to go in and actually pay a friend within 10 seconds. They're used to technology being part of their everyday lives. They're used to technology changing every year with a new version of a new phone or whatever. So the fact is that it's in their everyday life, and when they come into the work environment, that they almost have a mindset that just expects technology to be doing mundane tasks. Reconciliation. I used to love when I was in Treasury doing reconciliation.
I feel bad for you, Steve.
Well, and I'm publicly admitting it to however many people there are on here. I love reconciliation. Craig, you don't need to call anybody out. It's fine.
We need a T-shirt that says that for you.
I thought when he was talking earlier, he was going to pull out one of those whip inflation now buttons when he was talking about things. So
I do have a T-shirt that says "I'm a wreck." But anyway,
yeah. A question for you, Steve, though,
yeah.
We talked about technology, but the mindset and what people can do, the different generations. I mean, there's digital natives, like you talked about, very familiar with it. How do some of the different age cohorts or mindsets, how can they work together better? Dory started on that. Your quick comment.
I think from the point of view of the interaction, I think that even if we just can compare a boomer to a Z, I think we should be open to appreciate that we can learn from each other. The quick on their feet Zs that are able, or Zs as I call them, who are able to be very flightly on the technology. They can be teaching the boomers that actually technology is the friend. Technology is not there something to take your job. It's actually there to enhance your job, to make you more strategic in what you're doing every day. And similarly, for a boomer going back to a Z, the experience, advice, guidance, how to do the things you're doing, even if you can automate, and the benefits they're bringing to the business, and really just explaining, I think, the big picture that people coming out of college don't have, because they don't have that experience. I think it's really helping with that experience build.
Yeah, that's excellent. Let's not have a black box where nobody knows how it works. Yeah, working together is great. We have, I believe our poll question is showing, or it should be popping up. This is on forecasting. We're not necessarily doing these order. We're capturing information, and we have enough responses in the chat box. This is good. So go ahead and select all that apply for forecast and modeling. And then there's all those different options. And while that's going on, there's a question in the Q&A box. And so Dory and Steve Bullock. Thanks. I was going to get it. I could look at the screen, I guess. There's a question. Do you feel there have been any rate cuts this year? So you can say no or yes. But if you say yes, you got to say 1, 2, or 3. If you say 4, you can say that too. So Dory, why don't you go first? Any rate cuts?
In which country?
We're in the U.S. The U.S. Fed is what we're talking about on this particular one. Yeah.
I'm going to say no. Honestly, they're thinking only one. If it happens, it's going to be in December, November timeframe. I don't think, unless something breaks, it's just not going to happen this year. I don't think so. The economy continues to outperform what they expect is slowing, but it's not breaking.
Steve?
I think you'll see 2.
So yes, 2. I'm going to go yes, 1.
Both in Q4 of this year.
If I'm going yes, 1, it'll be in the fourth quarter. I think they'll keep pushing it out a little bit. It's been longer and later. And Dory, if it doesn't happen this year, do you think 1 will be in the first quarter of 2025? Okay.
I think it'll be in the first quarter.
Yeah. Perfect. Awesome.
But I don't think rates will get back down to the lows. I think we'll settle at like 4.5%.
All right. Yeah. Interesting. Yep. Yeah. And you look at the dot plots, those that are on the committee believe it'll be lower in the future years, but we'll certainly see how this rolls out. On the forecasting side, we'll leave those up on the screen for you to look at for a moment. to keep our conversation going, we're going to file this away and not comment on this other than use a TMS with some part of the process. I think since both of you work for Kyriba, a TMS vendor, this is probably good news. That means there's 66, 2/3 have an opportunity to add to modeling in there. So there's certainly a room for growth as the entire industry is trying to do more and better on forecasting. So lots of good options there.
Well, I read
On
this
the-
as there's 180 opportunities for us to provide a treasury system to people.
Awesome. So on the area of securing payments, this is a massively important topic. Cybersecurity, cyber fraud, payment fraud, huge issue. Companies are expanding. There's new payment rails. There's a lot going on there. And Steve, I'm going to ask you to jump in on this, but what are your peers doing? What controls do you have in place? You can see education, data protection, data loss prevention standards. Those exist all the way down to the principle of least privilege, isolating what people can do. Like in a TMS system, you have groups and functions, you segregate duties, you only grant access to things that people have. There's a lot of room for improvement on the control side. I will, Steve, I'll let you talk about payment security and what matters here and today.
Yeah. So I'm going to put technology aside for a second and just talk about the fact that, firstly, in our everyday lives, we're making payments, whether we're doing them for our firm or whether we're doing them for ourselves. So I think people are a lot more cognizant nowadays of issues that can occur, whether or not it's because a phone call from someone at Amazon that tells you that they've just taken $300 out of your account by mistake and they want it back, or you're contacted from someone in Kenya who says that they've got $1 million, but they need you to provide your bank information so that they can pay you half of it as a share. So I think that what it comes down to in the first instance is education. I think there needs to be a very thorough understanding in the organization, and there's tools available for this that really enable people to identify where there could be an impact, where there is a bad actor, where there are processes that they have that maybe are not as stringent as they need to be. The 4 eyes principle, for example, on payment approval at a minimum. You still have a lot of firms and businesses there that may be limited by the amount of people in their organization, or maybe they're limited by the amount of people that get involved in the finance organization, where their controls are limited by the amount of people that they can involve in it. So I think, again, ensuring that things such as counterparty SSIs are fully understood, that you have pre-approved templates of payments and who you can pay them, whether in your banking portal or whether they're in your treasury system. That then ensures that you're minimizing as much as possible any issues that can occur, and you're never going to remove risk. That's really not impossible. That's not something that you can make possible, but you really got to look at your organization and look to minimize every possible avenue there is for something to go wrong.
Yeah, good points. There's certainly good advances with criminals. Story, any additional comments on the world of securing payments? Criminals interject themselves, criminals removing security layers.
I think a lot of it has been accelerated with AI. This is the negative side of AI, right? We talked about the positive side of AI, which has an abundance amount of positivity. But what I'm seeing in organizations that I'm working with, at least that they've encountered, is deepfake voice recognition AI, where we're all doing webinars here, so our voices are out there. People know what we sound like. And they're leveraging technology to pretty much, let's just say, Steve is the next CEO of Kyriba, let's just say. And Steve makes a phone call, even though it's not Steve, with his voice sounds like Steve, sounds exactly like Steve, talks in his wonderful accent as well, saying, send me money here, and I'm going to send you an email, and it's going to be from me, and here's the paperwork. Send this money right away. It's an emergency, so on and so forth. We're seeing that. It's happening, right? People using investor presentation, webinars or things like this to get voices for high level executives and get organizations or people in the organization to execute on it.
Excellent. We're going to move in just a moment to the key takeaways, but just a note on the final poll question that's shown up there. Select all that apply. In the last 12 months, organizations experienced the following fraud attempts or losses. It doesn't have to be a loss. It could be just some attempt. Please check all that apply, hit select. Everyone will get a copy of these results from the poll. But, as we think about, we covered a number of things from geopolitical risk, cash forecasting, counterparty risk management, age cohorts, securing payments. Dory, if you would start us off on what are some top thoughts you want to leave with the audience, either something that you emphasized or something new, and then we'll go to Steve.
Yeah, I think we didn't touch on it as much, but on the people side of things, organizations today are not necessarily looking for the top-notch Excel wizard. They're looking for people who are familiar with the latest technology. And that's important when we talk about everything that we covered in this webinar, whether it's AI, increasing productivity, giving opportunity to top talent in the organization, whether it's on the forecasting side, making sure that you have data integrity, and more reliable, more timely forecasting information. All of that is tied to human capital and technology combining together. I think that's like technology and people are really in a deep rooted marriage right now, if you ask me.
Great. Thank you, Dory. Steve, your final thoughts.
Yeah, well, first of all, I'd like to thank you for the optional spelling of check provided on the poll. Thank you. But I think for me, the thing that stands out from this interaction today is around counterparty risk. As you mentioned, Craig, back in 2008, 2009, there were some counterparty concerns. If I think back to the 90s, there were some major counterparty concerns. More recently, there's been the SVB and the First Republic and so on. So I think it's really just maintaining that on guard aspect to your counterparties, because it's too easy to just think, oh, well, now I've got it with a Bank of America or JP Morgan, whoever you are maybe banking with after a change. But I think you still need to take on a very, very resilient perspective and think about what am I doing with them? What have I got with them? What risks do I have, if any? Even with the larger banks, as you mentioned, people say, as you said, they're too big to fail. But are they?
Yeah, excellent. Thank you both. And the reason why we did the alternate spelling was not just because we had a couple extra letters from our Scrabble game, the extra Q and the U, but it just helps on our polls to put both there. Thank you both so much. Thanks everyone for listening. Brian, if you could just take us home as we finish up today's webinar.
Well, thank you everyone for joining us today. The CTP and FP&A credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on all things Treasury, be sure to check out the Treasury Update podcast by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.